Hello, my friends. Today is June 17th. My name is Joseph, and this is Markets Weekly. This week, we're going to talk about three things. First, we're going to talk about whether or not the rally is finally over. Secondly, we will give an update on how the TGA is being refilled. And lastly, we'll review some of the central bank speak that happened this past week, and there was a lot of it. Okay, starting with the rally. Now, over the past few weeks, as we've seen, the stock market only goes up. And from my perspective, that's been a very, very dangerous development. You never want the stock market to go straight up because that suggests that there's some sort of mania, some sort of instability. And usually, just like Mount Everest, if it looks like it's going straight up on one side, on the other side, it's oftentimes a lot of downward volatility. Now, some of the really smart people that I respect are thinking that we should be really cautious, and they're looking at this from the perspective of options. So, as we've all learned through the, for example, GameStop gamma squeeze and so forth, options play a big role in driving stock prices. On Friday, we saw the indexes down a bit, and that coincided with a major options expiry. So in the options world, you have weekly options, you had monthly expiring options, but the really big options expiry dates are quarterly. So those are the expiration dates that have a lot of open interest. Now, what I've learned from studying really smart people like Jim Carson, Spark Gamma, Squeeze Metrics, is that the mechanism through which the options affect the underlying stock market is through market maker hedging. So structurally speaking, the real money investors, they are long puts and short calls. So let's say that you manage $1 billion portfolio. Well, you got to hedge some of that downside, right? So you go and you buy puts. And maybe to offset some of the costs of the puts and maybe to earn a little bit of income, you sell calls. But your calls are covered because you actually own the underlying stocks. Now, when the real money community does this in a structural way, obviously they have to trade with someone, and that someone is usually a market maker. So market makers take the other side of this trade. They are short puts and long calls. But market makers are not like speculators. They're not trying to make money through directional exposure. What they're trying to do is to make money off of the transaction fees. And so when they are either long options or short options, they go and they hedge that by buying or selling the underlying. For example, let's say the real money investors, of course, bought a whole bunch of puts from the market makers. So the market makers are short puts. Now, that means that if the stock market goes down, well, the puts become more valuable. That is to say, the short puts become more of a loss for the market makers. Now, the market makers, they don't want to speculate on direction. They're only there to make their fees. So when they are short puts, they have to hedge themselves by shorting stocks. Okay, so that means that when the market declines, from the market makers' perspective, they are losing money on their short puts, but they're making money on their short stock, so they are hedged. Now the question is, of course, how much stock do they have to sell given their options exposure? Now, that is actually going to vary a lot. It's going to vary depending upon where implied volatility is, and of course, how many days there are left towards expiry. Because the more days there are towards expiry, the more probability it is that eventually the options will end up in the money, and so the market maker who is short puts might end up with a loss. So when there's a lot of time towards expiry, all things equal, the market maker who is short puts in my example is going to have to short more stock. But as we approach options expiry, there's less and less time for that put position to become in the money. So as we approach these big options expiry days, the market making community who is structurally short puts has to gradually buy back the stock they sold to hedge that position. And those flows are very supportive for the market heading into these option expiries. Now, to be clear, the market can move a lot and the dealers could be positioned differently. But now, as we go into this options expiry, though, the stock market has gone straight up, and so those puts are becoming less and less valuable. And as time declines, also less and less likely to be in the money. And so the options makers are buying back their short stock position that they had initially initiated, and that's been supportive for the market over the past time. So now, though, after June options expiry, the open interest is more or less cleaned and reset, and so there's more of so those flows go away for a while, and so there's more of a possibility for us to have some downside moves. Now, the second thing that's happening in the options market, and I'll play this interview from Jem with TD now.
But lastly, vol up. Vol supply is becoming unpinned. Calls, all the call short interest, people wrote calls against all their stock, all the selling of vol that's been happening. It is now being squeezed out by stock replacement, how cheap these calls are. There's a fundamental basis for vol bid out there, and guess what? You're seeing it. We're seeing big block orders coming in, buying vol in all kinds of different parts of the distribution. Vol in dealers' hands is no longer pinned. It is quickly moving away from that place, and that is a dangerous recipe.
You have a lot of people in the real money investment community that are selling calls, and so they are a structural supply of volatility in the market. Now, look at this from a market maker's perspective again. So a lot of real money people are selling calls, so that means the market making community is long calls. So that means the market maker is basically long gamma. So let's say that that's the position right now. Let's say that the stock market rises a bit. Well, if the stock market rises a bit, that means that the market makers, well, they're making a little bit of money off their long call position. But of course, they're not in the business of speculating on direction. They're there simply for their fees. So as the market rises a bit and their long call position increases in value, they sell the underlying to offset that. So that provides stability in the market. So when vol is well supplied, or that is to say when implied vol is really low, it's more difficult for the major indexes to move a lot, simply because as it moves, the market makers push against that move to stabilize it. But what Jem is saying now is that because we have all these people who are doing YOLO call bets, or maybe just speculating by buying more and more calls, it's overwhelming the supply of volatility, the structural call sellers in the markets. And that's making implied volatility go higher, and that permits larger moves in the index. And that's another potential reason to be cautious going forward. It doesn't mean we're going to crash, but it does mean that some of the things that have been supporting the market don't seem to be there anymore. Okay, the second thing we're going to talk about is refilling the Treasury General Account. Now, earlier we talked about that the Treasury General Account was around $20 billion, and the US Treasury had a goal to raise that to about $550 billion by the end of this month. And many people were worried that that money would come out of the banking system, that is to say, it would be a liquidity drain, and that would have a negative impact on the market. Well, as of Friday, the Treasury General Account has risen significantly. It's gone from the low of about 20 billion to 250 billion. So there's been a meaningful rebuild in the Treasury General Account. And at the same time, it looks like the reverse repo facility has declined a lot. So it actually broke below $2 trillion for the first time in a long time this past week. Now, that together suggests that so far, a big chunk of the rebuild in the Treasury General Account has not come out of the banking sector, but it's come out of money in the reverse repo facility, which is, of course, neutral for markets. So that feared liquidity drain doesn't seem to have happened. Now, I think there's a couple reasons for this, and we also have to be cautious when we interpret what's happening with the reverse repo facility. First off, there was a lot of concern in the markets of this liquidity withdrawal. We had big investment banks writing scary pieces as to what could potentially happen. And the Fed and the Treasury, they are actually in tune with what happens in the markets, and they respond to it. And after the debt ceiling was resolved, the US Treasury came out with a statement modifying their plans for refilling the TGA. Initially, they had penciled in $550 billion by the end of June. They revised that down to about $425. So they lowered their target to become less ambitious. And secondly, they adjusted their bill issuance to focus more on the very short-dated bills. Now, I look at this and I'm thinking that they're probably doing this because they want to attract more money market funds to purchase the bills. Now, money market funds have expressed some hesitation in purchasing longer dated bills because they don't know the path of interest rates. They don't want to buy, let's say, a 6-month bill and then see that the Fed is actually much more aggressive in their rate hikes than expected. Then they would be sitting on some losses, and they don't like that. So one of the ways that the Treasury could overcome that concern is to issue a whole bunch of bills that are very short dated, let's say 6 weeks. So they've done that, and that could help money market funds participate more in bill auctions. Now, I don't actually think that all of this is coming out of the RRP, and I still think that part of it will come out of the banking system and part of it will come out of the RRP. Now, the drop in the RRP, you have to be very cautious interpreting it because it's not necessarily money funds going to buy bills. It's very likely, first, that on June 15th, we had a quarterly corporate tax payment date. And money market funds are basically just big wads of cash for corporate treasurers. So when a corporate treasurer wants to make tax payments, they go and they take money out of their money market fund and then go and pay the US government. So the money market fund then takes money out of the RRP, gives it to the corporate treasurer, and the corporate treasurer then pays taxes. That's part of it. The second part of it is that on June 15th, we had a major coupon settlement. So that means that a whole lot of long-dated treasuries were paid for by the dealer community. The way that the dealer community pays for these coupon purchases is by borrowing in the repo market, and the biggest lender in the repo market is, of course, the money market funds. And we see this in publicly available data as well. Repo volumes spiked high on June 15th, and that likely suggests that money market funds were taking money out of the reverse repo facility and lending it to dealers who then took the money to settle their payments to the US Treasury. So in a sense, it is draining the RRP, but these drains tend to be temporary, whereas the drains coming from bills tend to be longer dated, since the repo loans tend to be overnight. And once dealers who bought the Treasury securities sell them to their clients, they no longer need to borrow money from the money market funds anymore. So I would expect the reverse repo facility balance to bounce back above $2 trillion this week. But over time, though, there's going to be more money coming out of the reverse repo facility than expected because the Treasury is adjusting their issuance to encourage that. Now, the last thing we'll talk about is all the central bank speak that happened this past week. So we had the ECB meeting, and we also had some good information from the Bank of England and Fed Governor Waller. So the ECB hiked 25 basis points, and during the press conference, Madame Lagarde strongly signaled that they're going to hike again the next meeting. Now, why are they hiking? Well, honestly, it's the same thing we see throughout the world. Inflation has been stubbornly high, and their tools don't seem to be working as well as they thought they would. The ECB in particular is very concerned about wage growth. So wage growth in the Eurozone has been very strong, about 5%. And Not just that, productivity has been declining. So this is the same thing that's happening in Australia, which we talked about earlier. So if you're paying a worker more money and the worker is producing less, then your labor costs are rising. And that means that, that means that basically you have a situation where your wages are inflating more than is suggested by wage growth, and that could feed into other parts of the economy like services inflation, which seems to be what they're doing right now. And so they're trying to get ahead of this. A lot of inflation so far has been in things like energy and food. That's coming down, but the wages side, that seems resilient, just like it is in the US and many other countries as well. Bank of England, for example, recently is suggesting that they're going to have to hike rates higher than expected as well. Why? Same problem. Wage growth continues to be very strong and even seemed to accelerate this last quarter. We have a global labor shortage driven in part by demographics. And so try as they are, these central banks are having trouble getting wages lower because even as they're trying to slow down economic activity, we just don't have as many people joining the labor force as we used to. So that's going to be a persistent problem. And lastly, coming back to the Fed, we had Fed Governor Waller give a speech that was very hawkish. As you guys may have found out, Waller is a great hawk. Now, Waller is talking about the trade-off more recently between financial stability and monetary policy. There is a line of thinking that if you hike rates too aggressively, well, you could get inflation under control, but then you risk breaking something in the financial system, and that would be bad too. So you have to balance this pursuit of fighting inflation with financial stability. Now, Waller is nodding to this, but then he's also noting that, earlier in the year, we moderated our rate hike path because we're worried about instability in the banking sector and perhaps that the banks might retrench a lot in their lending. And so, in a sense, we won't need as many rate hikes as we thought earlier. Then he says that, well, it's not really clear that we've seen banks tightening their lending due to what happened in March. Now, they have always been they have already been tightening their lending for several months in response to a slowing economy and higher interest rates. But it doesn't seem like the March episode is having that big of an impact on it. So maybe that caution we had earlier in the year isn't warranted. He then goes on to say that, we really can't conduct monetary policy simply because we really shouldn't change the conduct of monetary policy simply because we have a few people who did a really bad job in managing their bank. We have to conduct monetary policy in light of our inflation mandate and not just change it because change how we conduct policy simply because some people screwed up. And I would also note, though, that the most recent dot plot had basically everyone on the FOMC signing up for more rate hikes this year. And that tells me that they are looking at the data in their banking system and they're actually not seeing significant deterioration either. So that's why they're comfortable in pricing in more hikes. And this is also what I wrote about in April. So it looks like it's coming to fruition. Okay, so that's all I've prepared for today. If you like what I'm producing, please remember to like and subscribe. And of course, if you're interested in learning more about the financial system and markets, check out my free online courses or my blog at fedguide.com. All right, thanks so much, guys. Talk to you soon.